Okay, so um, I posted the this review exercise, this handout, and this does a good job of kind of flying through the skills that we're going to be responsible for, at least from a quantitative aspect related to Chapter 11, which is our corporate reporting, but really it's transactions related to stock. All right. So let's. Hopefully, you've had a chance to work through this. If not, you may want to do that before you uh, use this video. That may be the best use for it. But anyway, let's get going. All right. On January 15th, Huron Incorporated issued 100,000 shares of its no par common stock. Each common share sells for $40. Huron also issues 220,000 shares of $10 par value 12% preferred shares. Each preferred share sells for $100. Journalize the issuance of these shares. So we've got two transactions. Let's do that. And you could do this as one compound entry, but it's probably easier to follow if we do it as two separate entries. So let's do it. Let's take that approach. January 15th. All right. $100,000 no par common stock. All right, so that raises cash. $100,000 shares, $40 a share. All right, 400,000 bucks. All right, and for the other side of the entry, we're going to need to debit an equity account. Common stock, no par. All right. Okay, that's 4 million. Let me make sure I didn't add too many zeros. 100,000 times 40, $4 million raised during the sale of common stock. All right, no par common stock. On the same day, the company also sells 20,000 shares of preferred stock, 12% preferred stock, for $100 each. All right, that raises $2 million. All right, now there's a par value, so that needs to go in a separate account. All right, and that's just the par value, so the $10 per share. $200,000, and then of course our plug, 1.8 million, is paid in capital in excess of par. All right, so that's how you journalize the issuance of par value stock. And for our purposes, it doesn't really matter at this stage whether it's preferred or common, right? Other than changing the name from preferred to common. So we've done all the things. We're done with the first part. All right. So let's continue on with the problem. At the June 15th, 2015 board meeting, Huron declares a $500,000 dividend to be paid September 15th. All right. How much of the dividend will the preferred shareholders receive? All right. So we can compute that. Well, the preferred shareholders, it's 10%. I'm sorry, $10 par value, and they get 12% of the par. All right. Um, so we need to compute that. So it's a $10 par, 20,000 shares. And 12%. And let me try that again. All right. So 24,000. All right. And so that's how much the preferred shareholders will receive. All right. So common shareholders are going to get the balance. So it's a $500,000 dividend minus the preferred dividend so common shareholders get 476,000. All right. Journalize the declaration and the payment of the preferred and common dividend. All right. So, let's do that because the dividend's declared on June 15th. All right. Retained earnings. Common dividend payable. Preferred dividend payable. So this is going to be your 500,000. This will be the 476, and your preferred dividend, which we computed, 24,000. All right. So that entry records when the board decides to pay the dividend. It reduces retained earnings because that portion of retained earnings is encumbered at that point, and it puts a liability on the books. All right. And the dividends paid September 15th. All right. Take the liabilities off the books. And you're mailing checks. So that is a reduction in cash. And all right, just like that. That's how we journalize the payment. All right, so we're done with the second step here. If we continue on to the third step, on October 15th, Huron purchases 10,000 shares of its own common stock for $30 per share. On December 15th, 2016. Well, actually, let's deal with October 15th first. We'll come back and deal with the rest. All right. October 15th. Company purchases its own shares, so that's treasury stock. $30. All right, so $300,000 worth of treasury stock, and of course they had to pay cash for that because it was in the hands of investors. All right. The problem continues. On December 15th, 2016, Huron sells 6,000 of the shares for $33 per share. All right. So the company is going to get cash when they sell the stock. 6,000 shares, $33. All right. Treasury stock. The main thing to remember with treasury stock is it goes off and on the books at the same rate. It always comes off and on the books at the price the company paid for it. This is treasury stock coming off the books. $6,000 shares. Company paid $30 a share. All right, and then we can plug the difference to paid in capital, treasury stock. All right, and just like that, we are done with this example. Okay.